And the governor of the Central Bank of Nigeria, Mr. Godwin Emefiele, has announced that its intervention to increase the monetary policy rate is yielding results as inflation is gradually decreasing month on month. Speaking at the end of the Monetary Policy Committee meeting in Abuja, the Apex Bank governor explains that the prices of food and general household goods is experiencing a fall, as expects a further depreciation through further tightening of the rate. While announcing the launch of the new Naira slated for today, November 23rd, he explains that the January 31st date for the collection of all Naira notes still stands, and there will be any form of extension. Take a listen.
It's the last Monetary Policy Committee meeting for the year, and after 2 days of deliberation, the Central Bank Governor and members of the committee intimate Nigerians on some of its key decisions.
Let me welcome all of you.
First, the committee takes a look at how activities at the international market is affecting the Nigerian economy following the impact of the COVID-19 pandemic, the Russian-Ukraine war, and on the domestic front, insecurity, costs of public debts, increased spending, and the trend in inflationary pressures. However, the committee notes that its interventions in the last 2 months are yielding results.
On month-on-month basis, however, headline inflation decelerated to 1.24% in October 2022 from 1.36% in the preceding month, an indication that price development is responding to the bank's recent policy rate hikes.
The governor then speaks on the decisions of the Monetary Policy Committee, which will see the tightening of monetary policy rate from 15.1% to 16.5% to tame rising inflation. The committee also retained the cash reserve ratio, CRR, at 32.5%, retained the liquidity ratio at 30%. The idea is to tame inflation, especially on food prices, which is likely to be affected owing to flooding in 33 states of the Federation.
Particularly for rice or for grain such as maize, we know that we have our own strategic reserves, which we will use to moderate prices as they get more aggressive. We've been doing a strategic reserve program for almost 3 years, and it is yielding results, and we believe that that will help to moderate.
Then comes an announcement on the new Naira notes.
We will not shift any deadline. What we have done is not against the law. It is in tandem with the law. Tomorrow, which is the 23rd of November, 2022, the President has graciously accepted to unveil the new currencies, and the new currencies will be unveiled tomorrow.
The central bank is confident that its intervention will yield the desired result in the coming days.
All right, for analysis now, we have Nnamdi Iwizu, co-managing partner, Commercial Partners, joining us via Zoom. Great to have you on the program.
Yeah, it's good to be here. Thanks.
So most analysts expected a 50 to 100 basis points hike, but we got 100, even though we got 150, at the last meeting. It's quite, soft. Looking at inflation is still elevated at this time. What are your thoughts on this 100 basis points?
Well, like you said, it was expected by most analysts, and we had anticipated a slower hike or a lower hike than the last one. But we have to realize that there's a lag between when actions are taken by monetary policy authorities and when you start to see the results in the market. So we haven't felt the full effect of the last hike that they had. And globally, you will notice that central banks have also started to slow down a bit on their own hikes. We've seen the Fed, for instance, in the US show guidance that hikes might go to like 50 basis points versus 75 basis points. So it's really natural that at some point in time, you have to slow down, look at what the effect of the previous hikes would have, or wait and start to see the effect of the previous hikes on the market before you talk about whether or not you want to continue raising rates aggressively. I remember the last time they also raised CRR which mopped up quite a lot of liquidity. They want to see how that plays out before they start to, I guess, decide whether or not they want to go more aggressive with regards to their tightening policy.
And the MPC was, obviously impressed with deceleration in inflation, on a month-on-month basis. Can we really attribute the previous hikes to this deceleration?
Well, I mean, yes. I mean, we would look at that as contributing partly to it. We can't say that's all, because we know that part of the inflationary pressure has to do with, logistics issues globally, has to do with dollar devaluation, Naira depreciation, has to do with, global high cost of goods everywhere. We've seen inflation in the UK at 11 and co. We've seen, which is record high, right? So we can say that, yes, the tightening definitely is contributing, but it won't be solely responsible to the slowdown in the hike. You have things like harvest, for instance, beginning to come in, which would also be partly responsible for that also. And the fact that at a point in time, consumers themselves just look at the high cost of goods and services and decide, look, we just need to slow down. We can't continue paying this. So I think the rate hike would have contributed, but definitely other factors would also have fed into that slowdown with regards to inflationary pressures.
And obviously, we know narrowing the negative real interest rate margin is of great importance right now. How do you think, we can boost investor confidence in this market?
I would say what investors like most is transparency. We still have quite a bit of an opaque system, for instance, around FX. Even same when it comes to interest rate policies and co. So, and generally government policies. So investors like to see transparency. They like to have a clear direction, with regards to where policy is going. And not just on the monetary policy side. You also have to look at the fiscal policy side. You have to look at security. So if we start to address some of those things, address security challenges, look at government spending, and then ensure that you create better transparency, in various markets, then definitely you start to see investor confidence come back. I mean, once the environment is conducive for investors, you really don't have to give them a lot of incentives for them to come in. What they just want most times is to smell the money, see a conducive environment, see transparency, know if they come in and they need to go out, for instance, or you need to access dollars, for instance, even if you're a local manufacturer, that you know exactly what the rate is, you know that you can get it when you want to get it. So I think that transparency is key.
And obviously, we've had a lot of volatility in the forex market. Do you think this latest hike would bring some kind of stability to the FX market?
Well, honestly, I really don't think so. You might have a bit of stability, possibly in the interbank rates, but I don't think this really helps so much when it comes to the power market rate. I mean, if people were to look at how much Naira has depreciated by in the power market rates and compare that with where rates are, it still makes sense for a lot of them to rather keep their funds in dollars versus Naira. So that continues to build pressure. If you want to use interest rates to fight currency devaluation, for instance, or depreciation, what you need to do is to, increase your rates to the point where your interest rate is higher than depreciation levels. So by the time someone checks and says, okay, look, I'm going to earn 20% on the Naira, but I think that the currency might depreciate by 10% over the year, so I might as well keep my money in Naira earning 20%. But if I see that depreciation is going to be, say, 30% and my interest rate is 15% or 16%, I would rather go and buy dollars, knowing that, at the end of the day, the dollar will outperform, outperform the interest rates I can get locally.
And today, with the CBN governor did announce they'll be unveiling the new notes today, later today, and obviously he did say that there will be no extension, for Nigerians that want to, deposit the old notes, into the banks. No extension, he says. What impact can we expect from this?
Well, I think what you will most probably see if you don't move the extension would be much more of a scramble by people all looking to do the conversion. Yes, I know you said 100 days is long enough, and 100 days is a long period. But I think we also need to consider the fact that beyond people in Nigeria, you have people who are outside the country, people who might have traveled out for, say, 3, 4, 5 month courses who don't have access to come back. You have people in certain places who, hinterlands, who don't really easily have access to the banking system, right? But I mean, the good side is the fact that they are starting earlier than December 15th, so that gives people additional time to start to change the currency versus the initial December 15th deadline. The other interesting point also is the fact that they intend to reduce the 200, 500 naira, 1,000 naira notes and focus on 200 naira notes, which in a way, I mean, it's still out there because there's still a lot of conversations around whether smaller currencies actually help to fight inflation. I mean, it's still being discussed out there by a lot of market enthusiasts and co. So there's no I would say firm decision on that. But I mean, one thing I do need to note is that they mentioned £20 as the minimum note you see in the UK, or the most used note in the UK. If you convert £20 to Naira, I mean, using para market rate, that's about 18,000. If you were to use official rate, that's about 10,000. So that is definitely a lot more than trying to push us to 200 Naira notes. But however, like I said, the good thing they're starting earlier would give people more time to go into the banks and change their notes if they have to.
And the central bank governor did joke, about Nigerians in diaspora not spending Naira, outside the country, so they shouldn't have any problem. What did you think about that?
Yes, I mean, I agree that Nigerian in diaspora shouldn't spend Naira outside the country. But, I mean, the fact is there are people who do have Naira and are not in the country right now. So, I know what they do in some developed countries would be that we would stop you from changing the old notes in the banks, and you have to go to the central bank to go and change it. Like in the UK, you have to go to the Bank of England to go and change old notes. So I want to believe that somewhere down the line, we might see that get implemented. I guess then you can ask for a lot more KYC and even limit the amounts that people have. So yes, Nigerians in diaspora don't spend Naira, but Nigerians in diaspora would have Naira over here.
Right. All right. What impact can we expect, on the fixed income market?
Well, we've seen continued tightening in the markets. We've seen liquidity very poor in the market opening, what we'll call short and negative, very little liquidity. A lot of people going to central bank to borrow. And at the same time, we've seen the increase in rates. So definitely we expect to see yields move up across the curve, bonds and T-bills. You have a T-bill auction today, and we expect it to close higher than we had previously, which was about 14% levels. People are expecting to close about 15% this time. But we definitely expect to see bond yields start to rise. The market opened about 15 minutes ago. I'm sure by the time we start to see runs, we would see that yields have moved up in the market.
And obviously, the MPC did raise concern over the bearish performance in the equities market. Do you see this trend continuing, or is there a bottom in sight?
Well, the truth about this is that there's a negative correlation between interest rates and equities market, right? If interest rates are going up, it makes interest rates more attractive, and people would not want to invest in equity. So if you look at what your returns are and you say to yourself that your dividend yields in a riskier asset class, which is equity, let's say maybe about 10 or 11%, I can go and buy 1 year T-bills at 14% discount rate, which effectively will give me about 17% in terms of yield. And also the fact that if I'm buying bonds, for instance, they're tax-free, and it creates less of an incentive for people to go into equities. So I don't expect to see the equities market pick up in terms of performance. until rates start to come back down. But as long as rates remain elevated, I expect investors to plow their money more into fixed income bonds, treasury bills, fixed deposits versus going into equities market to earn, lower dividend yields, and they can get in the other markets for an asset that is classified as riskier.
And obviously, we know investors all over the world now looking for ways to beat, inflation. Some have tried gold, some have tried, cash. But at the end of the day, most of these asset classes are suffering at this time. What do you think is the best mix right now to beat inflation?
Well, really, it's a tough one, because when you have inflation at 21% locally, and there are very few asset classes that you can get that would outstrip the 21% return. What I would say to you would be that it must be how you can reduce the negative return versus trying to outperform inflation at 21% at this point in time. We've talked about the equities market, which ideally should give you highest returns, being riskier than fixed income or money market and co. But you just talked about how poorly it's performing. So I wouldn't point at anything in particular right now that I would say can outperform inflation, except you decide to go into Eurobonds market. So we have some Eurobonds which are trading at 30% yield or 40%. But once again, that is distress levels, because the reason they're trading so high is because people expect some sort of default, possible default from the government. So that would only be for the strong-hearted. Beyond that, there are very few things. People say about a year ago would have jumped into Bitcoin, but we've also seen how that has performed. And besides, that is not even allowed to be traded by the bank. So I would say look at how you can reduce the negative return. You can go into treasury bills, you can go into bonds that give you effective yield of about 17% or thereabouts, or 18%, which would naturally reduce your negative real returns if you compare it to inflation, about 3%.
All right, looks like no asset class is safe at this time. Anyway, we've had the last MPC meeting, for the year out of the way. What are your expectations for the Nigerian economy going into 2023?
Well, I think for now it's still going to be challenging. We've seen GDP forecast for next year. We've seen where inflation is. We don't think inflation locally or globally totally disappears. So I still think going into next year, it's still going to be a challenging one. We are waiting to see, or we are hoping that the election brings about a change or brings about new economic policies, different thinking, and then change things. We know that going into next year, a lot of uncertainty in the run-up to the election. So naturally, that might further slow things down. But if you have a successful election, each free, which I expect, then you must have a bit of a bounce post-election, which tends to happen almost every year. And then you hope that whoever becomes the new president is able to formulate policies that lead us into, or lead us to take us higher grounds or have a better performance. So I think next year, start off, you have quite a bit of uncertainty based on elections, and then post-elections, you tend to see a bit of a boost to the economy. And then from that point on, we hope that, like I said, whoever comes in brings in good economic policies. What we've done so far is trying to study the economic policies of the three front runners and trying to know what to expect if any one of them wins. So that helps us position for post-election next year.
All right, all eyes on the next CEO. Thank you so much. That was Nnamdi Nwizu, co-managing partner, Commercial Partners. Thank you for your perspective on the show today.
My pleasure. Thanks for having me.